Hi everyone, welcome back. I'm Ching. Today we are talking about US bank earnings. So recently US banks have released their earnings, and the reason why I want to look at these earnings is because we want to see how are consumers doing, how are businesses doing, and we want to look at what the banks are thinking about the economy. Will we be in a recession, or will this high inflationary environment persist? So let's look at what some of the banks have said. I'll just want to look at the US consumer banks. They are JP Morgan and Chase, Wells Fargo and Citi, which they have released their earnings last week. And that will be part 1. Part 2, I'll likely be going through earnings from Bank of America and Goldman Sachs. Jamie, the CEO of JP Morgan, said, spend is still healthy with combined debit and credit spend, which they are up 15% year on year. They are seeing the impact of inflation and higher non-discretionary spend across income segments. Notably, the average consumer is spending 35% more year-on-year on gas and approximately 6% more on recurring bills and other non-discretionary categories. So non-discretionary are essentials. So at the same time, they have yet to observe a pullback in discretionary spending, including the lower income segments, with travel, dining growing at 34% year-on-year overall. So with spending growing faster than incomes, median deposit balances are down across income segments for the first time. So they are seeing maybe a slight decrease in savings since the pandemic started, but cash buffers still remain elevated. As we can see over here, average deposits are still up 13% year on year and 2% quarter on quarter. Okay, so debit and credit card sales volume is up 15% year on year. So people are still spending money. JP Morgan did mention that they are expecting the Fed funds to reach around 3.5% by year end. So as we know, 3.5% is a forecast, it may not be accurate. So if you look at the Fed's new dot plot over here, the market is expecting the Fed to increase their Fed funds rate above 3.5%, and afterwards in 2024 they will taper down. So as we know, the markets are forward looking. We are looking at the 10-year treasury yield. It's now hovering around 3% or around 2.9%. So the markets are definitely forward looking. Alright. So on average, we'll likely see the Fed funds rate be around 3% or less. This is the FOMC dots, alright, and the actual Fed funds rate. So as you can see, like in March 2014 or March 2015, these are the expected rates that the Fed will likely raise to. But as you can see, what is expected and what is actual is actually very different. So simply put, the dots do not have a good track record of predicting what the Fed would actually do. So we should think of the dots as forecasts, and like all forecasts, they can be very wrong. So consumers are in good shape, they are spending money, they have more income, jobs are plentiful, they are spending 10% more than last year, almost 30% plus more than pre-COVID. So businesses, they are talking to them, they are in good shape, they are doing fine so far. And they've never seen business credit better in their lifetime, and that's the current environment. But what about the future environment, which is not that far off, involves rates going up, which they are expecting rates to go up to around 3.5%, maybe more than people think, and it depends on inflation, and maybe they are expecting stagflation. They are expecting maybe a soft landing, hopefully. So there's a range of potential outcomes from a soft landing to a hard landing, driven by how much rates will go up, how much the Fed would do their QT, which is quantitative tightening, and the effect of a volatile market, and obviously the Ukraine war, the Russian war, and all the effects on food, oil and gas prices and on commodity prices. So everything is still very unpredictable and very liquid. So let's look at what Wells Fargo is saying. The allowance for credit losses for loans have reduced, which is very good. Consumers are in good shape, businesses are in good shape. And if you look at the average deposits and rates, if you look at consumer banking and lending, so consumer deposits actually went up. So from 835 billion to 898 billion. Overall, we are seeing more deposits. And if you look at net interest income, as we know, interest rates have been going up. Wells Fargo is making more net interest income, and they are up by 2.39% in terms of the margin. And in 2022, they expect net interest income to be 20% higher as compared to last year, which is the 2021 level of 35.8 billion. So if you look at overall, debit card spending was up 3% compared to a year ago. So when consumers receive stimulus payments and inflation appears to be impacting certain categories of spending, including a 26% increase in fuel driven by higher prices. So while discretionary categories like apparel, clothing, home improvement spending and credit card spend increased 28% from a year ago, above the industry trend driven by new products, and there's a double-digit increase across all spend categories. So credit card spend is still very strong. Alright, and of course it started to slow a bit in May and June. So consumer credit card utilization rates remain below pre-pandemic levels. Payment rates remain strong and delinquency rates remain low, which is very good. The economy is strong, consumer spending is still very strong. As you can see over here, credit card point of sale volume has increased versus last quarter and year over year. So if you look at consumer banking and lending, home lending revenue declined 53% from a year ago because of increased interest rates. It's more expensive to borrow, and it has declined 35% from the first quarter, right, driven by lower mortgage originations and compressed margins because of higher rates. And of course, the environment is still very competitive among banks and more financial institutions to loan money. So after increasing over 150 basis points in the first quarter, the Fed funds, mortgage rates have increased over 100 basis points in the second quarter. So the impact of higher rates also reduced revenue, right? Also reduced their loans purchase and securitization pools. So the mortgage market is expected to remain challenging. And if you look at the auto loan originations, and it has dropped, the reason is because there's a supply chain issue in chips for cars. That's why there's not enough cars around. Next, we look at Citibank. This is from Jane Fraser, the CEO of Citi. High rates and quantitative tapering will keep volatility high. They have the same consensus from JP Morgan. Wealth sentiment has shifted. Little of the data that they see tells her that the US is on the cusp of a recession. So we are not yet in the recession. The data is still very strong. Consumer spending remains well above pre-COVID levels, with household savings providing a cushion for future stress. And as any employer will tell you, the job market remains very tight. For corporate clients, they see robust demand, healthy balance sheet with revenue softness attributed to supply chain issues, constraints so far. So while a recession would indeed take place over the next 2 years, they are expecting a recession. It's highly unlikely to be a severe one. Maybe they could engineer a soft landing, hopefully. And in Europe, it's a different story. They expect a difficult winter is coming due to a possible disruption in energy supply like gas from Russia. So there's increased concern about second-order effects on industrial production and how it will affect overall economic activity across the continent. So the mood is of course very bad, right? And they believe that the war would not end anytime soon. And in Asia, the rebound in China will also be limited because of constraints of future lockdowns, because of the re-emergence of COVID and the amount of leverage in the Chinese economy and the stress in their property sector. This caused the whole global economy to be quite uncertain, quite volatile. But if you look at non-performing loans in personal banking and wealth management, it has actually reduced, right? That's very good. So revenues are up for them 6% year on year as growth in interest income more than offset non-interest revenue. As you can see, average deposits over here grew by 6% year on year. Okay, if you look at US personal banking, 3.8 billion, they increased to 4.1 billion in revenues. So if you look at branded cards, people are still spending on credit cards. Okay, it has increased 10% year on year. Alright, new account acquisition increased by 18% year on year. Credit card spend volume increased by 18% year on year. Average loans increased by 11% year on year. And in terms of global wealth management, average deposits increased by 7% year on year. So the consumer and businesses are still strong for now. Right? I'm not sure about the future, but currently the numbers are still looking very good. Hey everyone, I hope that you like this video and you find that this video is informative for you. And if you like this video, please click like. And if you like my channel, please subscribe to my channel, and so that you'll be notified immediately when a new video coming out.